Hey guys, thank you for watching. My name is Justin Carbonneau. This was a presentation that was given to a investing class at Old Dominion University in the summer of 2020. It's a quick presentation on factor investing. So it's a conversation on factor and quantitative investing with Validea's Jack Forehand and Justin Carbonneau. The first few slides weren't recorded, so I'm going to redo those here, and then you'll see in about 2 or 3 minutes it transitions over to the actual presentation where Jack and I are also up on the screen. So to start, we just gave a quick introduction to Validea. So Validea is an independent online investment research company. We've been running quantitative stock selection models based on great investors and other proven strategies that come out of the academic world. We run over 45 unique stock selection strategies that are made up of factors or specific investment criteria. On the site, there's a lot of different things we do with these strategies. So we create stock and ETF screeners. We have investment factor rankings, a stock analysis engine, model portfolios, and a lot more. So that's all available basically on the Validea.com website. We also are the guys behind the Validea Guru Investor blog. That's where we write original commentary. So both Jack and I write articles, and then we curate articles from around the web, interesting articles on the markets, on investing, that we think sort of stand above the rest. We do summaries of those and provide those for free on the Guru Investor blog. Jack and John Reese, the other partner at the firm and the founder of the company, they are the co-authors of the Guru Investor book. And lastly, we manage money for private clients through a series of systematic investing strategies through our separate capital management firm, Validea Capital Management. Okay, so to start, we just gave a brief overview of the basics of factor investing. So the first question is, what is a factor? What's an investment factor? It's something that explains the long-term movement of stock prices. Said another way, factor investing is an investment approach that involves targeting specific drivers of returns across asset classes of things like stocks. Factors have been around for a long time. Most academic work has decades of performance behind it. In the case of the French data, which is where they looked at the size premium, the value premium, that data set goes back to the mid-1920s. I believe it starts in mid-1926, and they run it all the way up through the current day. So it's decades of performance behind showing that some of these investment factors actually do produce a premium in the market over time. The major investment factors, there really are 4 that I guess most people can agree on. The first is the value factor. So that's buying stocks that look cheap based on something. That could be earnings, book value, cash flow. There's different ways to define value, and Jack will talk about that in a moment. The other factor that really stands out is momentum. So this is buying stocks or asset classes that are exhibiting relative price momentum versus other stocks or asset classes. Intermediate term momentum, which Jack will also talk about, that's kind of used mostly as the momentum statistic to identify stocks that have strong momentum. Then there's the quality factor. So this is buying stocks of good companies, and quality can be defined in a lot of different ways. Here you might think of like the Warren Buffett style of investing. So it's balance sheet or income statement look good in certain ways. And then there's the low volatility factor, which is buying stocks that show less volatility than the overall market. And that one's a little bit of a weaker factor, but Jack will explain it to you. But the idea there is you get like equal market-like returns with less volatility, which is always good. If you can lower volatility in an investment strategy, that can be a good thing. Factors work for 2 key reasons. There's usually a risk-based explanation. So that means that if you think of value stocks, you may not know this yet, but value stocks do tend to be riskier. They have more volatility than, most other stocks. And so because of that, value stocks tend to, over long periods of time, have a premium to them. But then there's also the mispricing or the behavioral sort of explanation or framework. So there's some reason that investors are mispricing these stocks, which contribute to why a factor works over time. What makes a factor reliable? So hopefully when you guys test and develop your models, you can think about and maybe even reference back to these 4 key pillars. So the first thing is it persistent? Does the factor show to be effective and work over time? And when I say over time, you want to test over the longest period of time possible. The next is it pervasive? You guys may not have the ability to do this, but does it work in different asset classes in different countries? So for example, in the academic world, when these guys test factors, they usually are testing it, like let's say on US stocks, but then they'll go out and test it on different global markets. So they want to see that value works in Europe, value works in Japan, value works in South America, and it actually can work even on different asset classes if you have a way to value those asset classes. Then the next thing is it robust? So what this means is really, can you define the factor differently? And we'll look at some of those ways that you can do that. Like for value, there's different ways that you can try to identify value type stocks. So that's one thing you want to be thinking about. And then probably one of the most important things is, does it make sense? Is it intuitive? Is it based on principles and economic theory that you think, and believe should work? I know with like Andrew and Systematic Alpha, I mean, one of the things that he does a very good job of, if he's shown you that model or walk you through it, is he can actually articulate and back into each factor he uses and why he just, forget the data for a second, why he believes that factor works both based on economic theory and based on principles that he has, seen in the market with his experience when he was a market maker on Wall Street and things like that. So that's just a quick intro. I'm going to hand it over to Jack now, and Jack's going to start walking you guys through these major factors, starting with systematic value investing.
Thanks. I wanted to start by talking about, well, actually, I'm going to do my second bullet point first, which is to talk about the difference between systematic value investing and discretionary value investing. There are really major differences, and they're really important in terms of how strategies are implemented. So, if you go back 20 years, pretty much all value investing was discretionary value investing, which means a person was making decisions about which stocks to buy and which stocks to sell. That person might have been going through annual reports, they might have been running screens, but however they were doing it, a person was making that decision. We are systematic value investors, which means a computer is making the decision for us. We're trying to play the law of averages. We're trying to buy baskets of stocks that meet, our value investing tests, and a computer is identifying those, and we're trying to take advantage of value on average using that. So it's important to understand those two different things, although they can end up in the same place. A person can pick some value stocks and end up with the same stocks a computer will pick. The way we do it is very different. So taking a step back and just talking about the different types of value investing, there really are three different major types. And, some people will argue some of these are not really value, but, different people do things in different ways. So the first is Ben Graham value, and that is essentially just buying stocks that are really cheap. And that's the way most of us think about value. Most of us think about, let's find the cheapest stocks in the market. Let's buy those. Over time, we'll do well with those. The price will improve relative to the fundamentals. That's Ben Graham value. Then another popular one is what I like to call Warren Buffett value. What that means is I'm not just trying to buy the cheapest stocks. I'm trying to buy really good companies, and I'm trying to buy them at a discounted price. And so that's sort of like a middle of the road value strategy. I don't want the absolute cheapest bottom of the barrel stuff. I want companies that are pretty good, high quality companies, and I want to pay a reasonable price for them. And then the third is what I call Bill Miller value. And Bill Miller was a manager of a mutual fund. He still is today, but he was he beat the S&P, I think, Justin, was like 17 years in a row or something like that?
Something like that. Yeah, 16, 17 years
so in the late 90s, he beat the S&P for like in the 80s and 90s by 17 years in a row. And what he says is basically you want to buy companies that are trading at a discount to what they're going to be in the future. And so these companies can actually not be cheap at all from a value perspective. So if you think about Tesla right now, Tesla 5 years ago, by this definition, was a value stock because what I get for my share of Tesla today is much, much more than I would have gotten 5 years ago. So by this definition, Tesla, relative to its future growth, 5 years ago, Tesla was actually a value. So those are different ways to look at it. When we talk about systematic value investing, we're talking about the first one, which is we're talking about, when academic research is done around value, they're typically buying the cheapest stocks and maybe not doing the other ones. But that all three approaches are used, and they're used by discretionary managers and systematic managers. So next, just to cover the basic value metrics quickly. Justin talked about this earlier, but there's a lot of different ways you can define value. And in the space we operate in, there's a lot of arguments right now in terms of which is the best way to do it. So obviously you have the PE ratio, which is just the price divided by the earnings. You can have the price to sales, which is pretty self-explanatory, price to book, price to cash flow, or EV to EBITDA. Those are basically the major five. And what you'll see is when you see value funds that are managed, some of them rely on one of these very heavily, and others will use a bunch of them. Others will use what's called a value composite, where they'll use all of these simultaneously. So the one of these that's very controversial right now is the price to book ratio, and we might talk about that later, but I won't get into it too in depth. But because so many companies have a lot of assets right now that are not on their balance sheet, if you think about the value of Google's brand or something like that, that's not reflected in their book value, and so a lot of people think the price to book is no longer useful. So we won't debate that whole argument here, but it's the most controversial of these factors. And then the only other thing I want to cover quick is the importance of negative screens. So one of the things that happens with value stocks is great companies are usually not cheap. So usually when we're buying value stocks, we're buying companies that have significant flaws in their businesses for one reason or another. And so what we found, and what a lot of quantitative managers do, is we try to screen out the companies that have the most significant flaws. And so we have a system that uses a bunch of different criteria. So for example, if a company has a ton of debt and they're a value stock, well, their chances of getting over whatever their problems are less if they have a lot of debt. So that's an example of something where we might screen out, certain stocks and say, all right, we're going to take the absolute bottom worst stocks and we're going to screen them out before we actually implement our value strategy.
Yeah, and the only thing, just to build off on the value metrics, and you guys have probably done this, but if you haven't, it might be helpful. Just, after this presentation, like calculate the PE ratio. Assume you have two companies. They both have a price of 10. One makes $1 in earnings per share. The other makes $3 in earnings per share. So what you want is a lower PE ratio. So on these metrics, lower is typically better from a systematic value investing standpoint. And sometimes it just is if you just isolate it and say, okay, company A has a price of this, company B has a price of this, and you just do it out, it'll help you sort of understand what these ratios are actually trying to do.
Yeah, and a good way to look at value is if you were just going to invest in a company that's not traded on the stock market, if you're just going to invest in a company down the street from you or something, what would I want to do? I would want to pay as little as possible for the earnings I get, or I'd want to pay as little as possible for the cash they generate for me, or I'd want to pay as little as possible for their sales. So that's basically what value investing is. It's something that doesn't just apply to public stocks. It applies to any area of trying to acquire businesses.
Okay, so let's move on to so here's the why behind systematic value.
Yeah, and so going back to the framework Justin gave earlier, there's typically two reasons a factor works. Either it's because it's riskier or because there's some sort of reason that other investors are mispricing the stocks. And so most academics believe in value, both of these are true. So a lot of people think if you buy companies that are very cheap relative to their earnings, that you're actually getting lower risk companies because they're cheap and because you're getting a lot more earnings for your money. But the opposite is actually true because these companies typically have significant problems. And so when there are significant problems, those problems could be resolved positively or they could be resolved negatively, and you get a lot of volatility around that. So one of the reasons value works is just because it's riskier. The other reason it works is if you buy a basket of cheap companies, typically investors have overestimated how bad the problems are with those companies. They've overestimated what's gone wrong. And so if you buy a lot of them, if you buy a cheap basket of companies, you can take advantage of that fact that eventually investors will realize that things aren't as bad as they seem. And so that's the main behavioral reason why people think the value investing works. Moving on, we'll just talk about momentum investing briefly. Momentum is one of the toughest factors for people to understand because it doesn't make sense to a lot of people that I should just buy this thing because it's gone up a lot. You want to have some sort of fundamental reason or something going on with the business or some reason to say, hey, why should I buy this company? But momentum doesn't do any of that. All momentum cares about is that the price has gone up. But momentum is very robust. It's been tested by a lot of academics and it holds up. And so if you buy stocks that have been up in the previous 3 to 12 months for a period of time, that momentum typically continues. And so, it's a very strong factor and it's supported by a lot of academic evidence. And, most people think value and momentum are the two strongest factors. So this is, this goes right up with value as one of the major factors. There's two types of momentum. One is called cross-sectional, which is where I compare one thing to another thing. So for instance, if I have two stocks to choose from and I need to buy one or the other, with momentum, I would buy the one that's gone up the most in the past 3 to 12 months. So I would compare them to each other based on their price performance and pick the better one. Time series is when you compare the prices of an asset just to itself. So for instance, you'll see this commonly, the word trend following commonly used for this, and what you'll see it used on is things like the S&P 500 or something like that, where you say, all right, if the S&P 500 goes below a moving average, which is just the average of its prices over a long period of time, if its current price goes below this average of prices, I want to sell the S&P 500. And when it goes back above, I want to buy it. But the key with time series is the only data I need for it is just the price of that asset. I don't need anything to compare it to. Just going through the basic measures of momentum quick, you have relative strength, which you'll see pretty common. It's a score from 1 to 99. Basically, the stocks that have gone up the most in the past year are 99. The stocks that have gone up the least are 1. A measure used by a lot of academics is something called 12 minus 1 momentum, which is basically the return of a stock in the past year, but you don't consider the most recent month. And the reason you don't do that is because typically momentum in the most recent month will revert, so it'll head in the other direction. So by buying stocks that are up the most in the recent month, you actually get the opposite effect of what you want. And so 12 minus 1 momentum will just use the 11 months out of the 12, and it won't use the most recent month. And then moving averages, which we talked about before, that's used in time series momentum. And then just a couple other points from our research around momentum. One is momentum works best when it's consistent. And so if a stock goes up in a straight line, that's typically more predictive of the future than if it is going up and down wildly. Even if those two stocks end up in the same place, the one that was consistent typically has better future returns than the one that wasn't. And the second thing, and this is from one of the strategies we run in Validea, is if you don't just consider the price, if you also consider the momentum in the fundamentals of the company. So for example, if earnings are going up and price is going up, what we found is you actually can get a better return. So you can enhance momentum by not just relying on the price, but also relying on, are the fundamentals of the company getting better?
Yeah, and one of the things, as you guys look to do your tests, I don't know if this would be possible. I think you're kind of being asked to create one factor-based model, but value and momentum tend to actually complement each other nicely. So one of the things you guys could experiment with is you guys could build a value factor strategy and then a momentum factor strategy, and then try to look at how the two, imagine those as being two different portfolios, and then how the return streams, when they come together, how they look. I mean, you might get better risk-adjusted performance because value and momentum tend to behave and work differently in different types of market environments.
And hey, just so you know, yeah, we can actually combine value and momentum in the model on Bloomberg. So those are some great points. And, after this, certainly, Jack, I'd love to get, some specific ideas to give to students because, to make it as simple for them as possible. This is awesome. Thank you.
Sure, absolutely.
Sure.
Okay, next, the why behind momentum.
So we're back to the same thing again, which is, typically momentum stocks are a little more riskier than the market, but the major argument for momentum is typically the mispricing argument, which is, it's sort of the opposite of the value argument. So value, we underprice companies that have bad things going on. With momentum, we're basically underestimating the good news. So these companies have good news, their stocks go up, but they don't go up as much as they should. People underestimate how good the news is. And there's another thing called reflexivity, which is really interesting with momentum. And you saw this with Tesla. What's going on with Tesla? A lot of people thought Tesla was effectively going to go bankrupt, a year or two ago. And what happens is when good things start happening, it can lead to other good things. And so, for example, with Tesla, the stock price kept going up despite the fact that people thought it might go bankrupt. And so now Tesla can issue stock at this higher price. And so good things are leading to other good things. So even if Tesla was very close to going bankrupt, this reflexivity principle essentially prevented that from happening. So it's another interesting argument for momentum. Let's see.
Low vol.
So moving on, we'll talk about low volatility and quality really quick. So low volatility is a factor that most people think is maybe not as strong as value and momentum. But effectively what low volatility is just what it says. It's investing in stocks that are less volatile in the market. And it sort of flips basic investing on its head. And so that's one of the reasons people aren't as confident in it, is because in theory, if I take more risk, I should get more return. If I take less risk, I should get less return. With low volatility, I'm taking less risk and I'm getting more return. And it certainly is held up in the data. So, you can't argue that low volatility does work. With low volatility stocks, you do take less risk and you typically either get the same return or you get a greater return, which doesn't make sense, but it does happen. There's a lot of academic research to back it up. There's different ways to measure low volatility. One is sort of the standalone risk of the company. And there's two ways people typically do that, or the main way is standard deviation. So it's just effectively how volatile is the stock. That's one way to measure low volatility, is to measure the volatility of each stock in terms of how much it moves around over the course of a year or something like that, and then to just buy the least volatile stocks. And then the second way is how much risk does it contribute to a market portfolio, and that's where beta comes in. So the difference between beta and standard deviation is beta doesn't just take into account how volatile a stock is, but it looks at how much volatility does this stock add to a portfolio of stocks you already have. So a stock can be volatile, but it can move the opposite way of the market, and that stock can actually have a low beta even though it has a high standard deviation. So you see both of these used in the real world. There's not necessarily one that's better than the other, but I just wanted to highlight both of them. In terms of why low volatility works, this is a tougher one. There is no risk argument. Low volatility stocks are not riskier than the market, so you can't explain it based on risk. So what people use is the mispricing argument, and there are a little less strong arguments, but so for instance, one way you could explain it is you could say your average investor doesn't have the ability to use leverage in their portfolio. And so if they want to get additional returns, instead of borrowing money to get additional returns, what they'll do is they'll buy the riskiest high beta stocks. And so they'll drive the price of those riskiest stocks up beyond what they should be. And so on a relative basis, these low volatility stocks offer a better bargain. That's basically the main criteria, or the main reason people say low volatility works. Just a few other points on low volatility. One is, what we say in the presentation is low volatility is a chameleon. And what we mean by that is low volatility goes wherever there is low volatility. And so people tend to say, all right, a low volatility strategy is buying like a bunch of utility stocks or something like that. But it's not. It's different things at different times. It's in different industries at different times. It's in different sectors at different times. All it cares about is what the volatility is. So it can be anything. It can be expensive stocks at times. It can be cheap stocks. It can be anything. It's a chameleon. It changes. And another important point is low volatility versus minimum volatility. You'll see if you ever look at the ETFs that are out there, you'll see some that are called low volatility, and you'll see some that are called minimum volatility. And the difference is low volatility are just looking at the individual stocks and their volatility, and they're adding those to their portfolio. Minimum volatility is looking at how the stocks interact with each other. And so they're trying to use like an optimization to say, I want the portfolio volatility to be as low as possible. So I can add lower volatility stocks and I can add higher volatility stocks. What I care about is the combination of them. I want that to be as low volatility as possible. And that's what minimum volatility is. And the other thing is, point I want to make is low volatility does work very well with the other factors. So even if you're a believer that low volatility is not a great factor to use on its own, it works really well with value. It works really well with momentum. There's actually been some studies that have found that the vast majority of the excess return over the market that low volatility generates is when the low volatility stocks are also cheap. So it's worked best when it's combined with value, in that case. Just to talk about the final factor we're going to cover is quality.
Yeah.
Yes.
Yeah. Can I ask one question? One question I always, and so one of the things I thought about low vol, everything you said was great, but one of the things is about the actual math involved. Like, for example, if you're a fund manager and, you lose 50% of your, you have 50% drawdown, you then have to make 100% to get back up. So is it just, I always thought that one of the reasons low vol works is just simply because of the math. So, you have another fund manager who makes 10% a year. They can do a lot better than one who might average higher but have a lot more vol, Yeah,
no, that's right. Obviously, when you have major declines, they're harder to make back. So I think you're totally right about that. And there's another argument for low vol, which is the behavioral argument, which is you want a strategy investors can stick with, and the less volatility there is in that strategy, the more likely investors are actually likely to realize the return of the actual portfolio. And so low volatility can be better than all the other factors from that perspective, because you won't have the investors bailing, because of the volatility. So I'll just cover quality really quick. I mean, quality is basically what you think it would be. If you think about a good quality company, it's typically profitable. It typically has a consistent business. It might have low debt. If you think about Warren Buffett, a lot of people associate that with, a quality type style of investing. One of the important points to keep in mind with quality is it probably has more ways to define it than any of these, of the other factors. You can look at quality in many different ways. You can look at it as profitable companies. Like I said before, you can look at it as low debt. You can look at it as the consistency of earnings or sales. You can look at quality in many, many different ways. And, the major firms that follow systematic quality strategies do that. They typically use many factors in terms of determining if something is a quality company. Quality is also hard to explain, just like low volatility, because again, you're not taking, if I'm buying these good, profitable, consistent businesses, it's hard to argue I'm taking any more risk. So the risk-based argument doesn't work. There are various mispricing arguments, and they're sort of similar to the low volatility arguments, meaning that investors who are trying to get better returns will chase things like lottery stocks. They'll chase these lower quality stocks trying to get better returns, and they'll underprice the high quality stocks as a result of that. And then again, quality is typically used with other factors. Many of the people we know that manage value portfolios, for instance, use quality to some extent, because you want to try, like I said before, a lot of value companies have major problems in their businesses. So by putting these positive quality factors in there, you can try to filter out the bad companies, and you can try to get companies that are cheap but are also reasonable businesses. And so you'll see quality used, with other factors in pretty much all portfolios, especially value portfolios.
Yeah, just in terms, I think of kind of trying to wrap it up, we wanted to just sort of share with you some of what the pros and cons are of factor-based or systematic investing strategies. So obviously on the plus side, they're unemotional, they're systematic, and it removes the emotions and the biases from the investment decision-making process. I mean, anytime you can be more disciplined as an investor, that's usually a good thing, because a lot of times our emotions and biases can get us in trouble. The other thing is with these factor-based strategies, when you run them, and you guys will see this, you're going to be able to run them on the entire market and find opportunities across, thousands of securities. So you'll be able to find the best opportunities in all areas of the market. The other thing is with these types of factor-based strategies, you're able to test them. So you're able to see over long periods of time how robust each factor is, and the periods it works and the periods it doesn't work. And then the last thing is, they're transparent, clear, and it's a repeatable process. So when you guys develop your factor-based strategies, you're going to be able to say, I used, the PE, relative strength, I looked at whatever cash flow, and you'll be able to, the criteria, the factors in the strategy can be articulated, and you'll be able to sort of tell Andrew and talk to those factors. On the negative side, factors aren't able to adjust to changing market dynamics. So as markets change and businesses change, I mean, Jack kind of hit on this intangible asset thing. I mean, 30 years ago, companies had a lot more hard physical assets, plant and equipment, on their balance sheet. Now, a lot of that is intangible assets that doesn't show up. So certain factors aren't going to be able to uncover those intangible assets unless you adjust for them. The other thing is, and this is very important, and we've seen it with the value factor over the last 10 or maybe even 15 years, is that factors can go through very long periods of underperformance. There's been some research out there that shows even over a 20-year time frame, when you look at buying cheap stocks based on the value factor, about 4% of the time value underperforms. So it's not like, value always outperforms over, it usually does, but it doesn't all the time. And then the last thing with factor-based strategies, and we'll sort of talk about this in a minute, but you got to be careful about data mining. You can't just throw a bunch of stuff together, and if the performance looks good, think it's a good strategy, because if there's not rationale behind it, it just isn't probably going to work in the future when you come out of it in the real world. And so
a good example of that is I think Justin mentioned you guys will be testing from 2006 on. One of the things you have to be careful about is looking at the period you're testing and how that relates to the full history. So what I mean by that is, if I wanted to give you, I could tell you right now the best strategy you could develop probably from 2006 on, it would be buy expensive large companies. But if you look at buy expensive large companies over the full data set, it's a horrendous strategy. And so you have to be careful about looking at the period you're testing in and what actually worked in that period relative to what works over the long term. Because you could end up developing a strategy that'll work great from 2006 on, but it won't work during periods where value is back in favor or something like that.
Right. So just I think some parting thoughts, and Jack, you can build off of any of this, but I think to start, when you guys develop your strategies and think about these factors, and we'll send you some, Andrew, if you'd like, we can try to go through the factors we talked about and identify some of the actual investment criteria that these guys might want to use. But what they should also be thinking about is the why behind the factor. I mean, what is the factor really trying to get at, and why they think it might work. Blending factors obviously is going to be probably what you guys end up doing. So that's most of the strategies we run. I think all of them, use more than one factor. As Jack just pointed out, there's something called in and out of sample testing. So what you guys might consider doing is when you develop these tests, Andrew, are they using Bloomberg and going back to 06? Is that what they have the ability to do? Oh, you're muted. Oh, unmute. Oh, you're muted, Andrew.
Sorry, there we go. Sorry about that. Sorry. Yes, they can go back. They can go back even beyond 06. I picked 15 years to make sure they get the 2008, bear market. I can also have them do some international testing for some out of sample data.
Mm-hmm. Well, one thing you might consider is, breaking your data up into two parts. So they develop the strategy, they test it from whatever, 04 through 2012, and then, then test it on the out of sample data from 2012 to 2020, something like that. Could be an interesting way to do it. I mean, I don't know how much time these guys have, but that's just something to consider. And then, I think in terms of one of the ways that Validea might be able to be helpful for you is we can give you guys access to the site, and maybe some of the guru strategies and some of the criteria used in there, can also be used in your testing. So you don't need to reinvent the wheel here. Try to use what's already out there to find interesting combinations of factors. And then just the last point is the long term can be a very long time. As I just mentioned, value can actually underperform 4 to 5% of the time over a 20-year period. So there can be, and there has been, very long-term periods of this factor underperformance, but the factor has always, the ones that are proven at least, have always come back and reverted back. So that's just something to also keep in mind as you guys build these tests.
Yeah,
so that's it.
Yeah, well, this is wonderful. I just, I did give them, I in my syllabus, I put your Validea website and your excess return podcast for them to look through. Okay. And so we started, we looked a little bit on your website. I don't know how much time you have. Did you want to show us anything specific from Validea, or how much time do you have?
Yeah, I can do that. Let's just go. You might not be seeing my screen yet, but I will.
Yeah. And also, and the other thing, I'd love more guidance if you don't have time now, but, the momentum part is interesting. Like one of the things, if you look at momentum just from a pure math basis, right? Usually in the short run, you have reversion to the mean, but in the long run, you have these trends. So that's why you're using, what Jack mentioned, right? You're using like 12 months minus 2 months or something like that. I don't know if you can go, if you or Jack can just go in a little bit more about some of the things we could test on momentum.
Yeah, basically momentum is that intermediate term period is what's the most important. And so like you said, the current month typically needs to be excluded because you get mean reversion. And also over the long term, you get mean reversion. So once you get past 12 months, like 24-month momentum doesn't work at all. You typically get mean reversion there too. So it's like staying in that sweet spot. But two things we've tested, and I don't know, it's hard to quantify it, so it's hard to do. But like we talked about there, we found the consistency, and this comes from Wes Gray's book, Quantitative Momentum. Consistency can be really important. The more consistent the momentum is, the better it works. And the way we do that is from his book, which is basically you look at every single day and you determine whether it's an up or a down day over the past year, and then you want the highest percentage of up days relative to the total days. And so that sort of tells you that you've had consistent momentum. And then the other thing we've looked